Good morning, AICPA. How's everyone this morning? Again, Michael Williams. I'm Vice President of Association Relations with United Transactions. For those of you not familiar with UTA, we are the largest check guarantee company in the nation. We're new to AICPA, but we're not new to the automotive industry. As a matter of fact, we currently have a 37% market share in new car dealerships with check guarantee. And we service over 50 of the top 100 automotive groups across the nation. So there's got to be something to it. We'd love for you to come by. We have Rafael Cervantes and Phil Wasserman with us this morning, two automotive experts in the booth, and they will be, combined. They have about 55 years of expertise in the automotive industry, real giants. So we'd love for you to come by. UTA is also a partner for the past 20 years, a gateway partner with WorldPay, the largest credit card direct processors in the world. So we have expertise in that area as well. We get this morning to introduce our keynote speaker, Jeff Bush. Jeff says no relation to the political family or the baked bean guys. Jeff is an author. He is a conference speaker. Jeff had over 200 keynote speaking engagements last year. Got his own jet, so he can go. He sometimes does 2 or 3 a day. So he's got a lot of expertise. You may have seen him on CNBC as a contributor. Or possibly seen some of his work as an author. So what I'd like to do is, there's one thing about your bio, Jeff, that grabbed my attention. And in the first sentence of his bio, it has 3 things. It says, 1 is dynamic, and 2 is complex tax, and then 3 is Washington, D.C. And anybody that can put all of that in one sentence has really got to have the goods. So, Jeff, would you come on up, please, and wow us today?
Thank you very much. Appreciate that. Great job. Thank you very much. I appreciate the opportunity to be here today. It's going to be a fun hour or so that we get to spend together. I imagine some of you have seen myself or my colleague Andy Friedman before, but in case you're not aware, we're a very nonpartisan look at what's happening in Washington, D.C. And a lot of people interpret the word nonpartisan as meaning that we don't have an opinion. Well, I think you'll find over the next hour the exact opposite of that is the case. What nonpartisan means to us is we don't mind pointing fingers at either party. And I think you'd agree they both deserve a finger or two pointed at them, and I'll let you choose what finger you point. So along those lines, I thought about this audience on the plane ride down here last night, and I kind of played with the presentation a bit in order to hopefully customize it and make sense of it for you. And when I thought about it, I thought, Jim Mad Dog Mattis, our defense secretary, said it best for all of us who work within the D.C. area. In September, he was speaking at VMI, and he said, I'm so happy to be out of Washington, D.C. right now, I could cry. So I want to thank AICPA for giving me the chance to get out of the Beltway for a while. It's always a nice break, and I do appreciate that opportunity. And as I mentioned last night on the plane, I was thinking about what types of things should we talk about today. And I started making a list, and the list got very long very quickly. And I said, my gosh, we could spend 3 days talking about all these things that are happening in D.C. and in the headlines right now. And even if we did have time to talk about all of these things, that still wouldn't touch the tax reform impact as well as the fiscal situation we find ourselves in the United States. So I had to be a little bit picky and choosy, but I will give you access to the entire presentation. About halfway through, I'll give you a text phone number as well as an email address, and you're welcome to text me or email me, and my associate will get out the full presentation to you. So with that as kind of a kickoff, I want to start with the midterm elections. Now, does anybody know what this map represents? The 6 most highly gerrymandered House districts from around our country. My personal favorite is the upper right-hand corner. That's Goofy kicking Wile E. Coyote. Now look at that. They had to try to make that look like Wile E. Coyote, didn't they? I was in San Francisco last week, and I was speaking with all these tech millennial folks. I'm not disparaging millennials, but tech millennial folks, and I made that joke, and it literally fell flat. They didn't even know who Wile E. Coyote was. So I appreciate the few laughs that we got on that line. Now, there is some confusion as to what gerrymandering is. Everybody's familiar with step one of gerrymandering, but it's actually a two-step process, and those two steps combined is what makes it so powerful. Step one is the fact that we put just enough of our voters into as many districts as possible so that we have a reasonably high chance of winning that district. But step two, as I mentioned, is equally important. Step two is cramming as many of your opponent's voters into as few districts as possible. And it is that two-step process that makes it so powerful. Now, gerrymandering has been with us since the early 1800s. This is nothing new. Democrats practice it, Republicans practice, everybody practices gerrymandering. What's changed in the last several cycles, or at least the last cycle, is the use of big data. Literally, the parties can draw lines down a particular street, skip those two houses, and move on down the street. The data is that good in their ability to gerrymander. That's how we end up with these real goofy-looking districts, but it also creates an environment in Washington, D.C., where our elected officials are actually politically disincented from working across the aisle. Let me explain. If I'm a Republican in a Republicanly drawn district, that a Republican will always win my district, do I care who the Democrats run against me? No, a Democrat's never going to win that district. What I'm worried about is being primary challenged from my conservative right. If I'm a Democrat in a Democrat district, I don't care who the Republicans run. I'm worried about being primary challenged from my progressive left. So what that forces me to do when I'm in Washington, D.C., and I'm asked to take a vote or give a position on a certain issue, it forces me to run for the walls. Now, you can kind of visualize that, right? You have Democrats running this way, you have Republicans running this way, and if they're all running for the walls, what are they not doing? They're not working across the aisle. You see, we've created a situation in the House, and I would argue now it's bubbled up into the Senate, where our elected officials are politically disinterested, and actually it's seen as a political negative if they work across the aisle. That's the real problem with gerrymandering, and we tend to giant gerrymander ourselves moving forward. But let's talk about the House election when we get into some detail. It may make a little more sense. For example, in the House of Representatives, Democrats only need to pick up 23 seats. And the challenge for the Democrats is that in 2016, only 7% of the House was decided by less than 10% of the vote. There just aren't that many competitive districts in the country, and that's the gerrymandering issue. Now, it doesn't mean the Democrats don't have some tailwinds. They absolutely do. If you were to ask me, Jeff, well, how often does the out party, in this case the Democrats, how often does that out party actually pick up in that 23 seats? Well, believe it or not, it's a 50-50 deal, a flip of a coin. And those are pretty good odds. I think we'd all agree. We play roulette or blackjack. We play things like that. But there actually, if we add one more statistic, the story gets a little more interesting. What happens if the sitting president, in this case Donald Trump, has less than a 50% approval rating? That win ratio goes from 50-50 to 87% of the time. That's the big blue wave the Democrats think is heading for the Republicans this November. I'll stand before you right here today, and I will promise you, there is a blue wave heading for the Republicans this year in the House. The problem is we don't know if it's a North Shore Hawaii wave or a Mississippi River wave. We don't know. We don't know because there's still way too much volatility in the headlines in the generic ballot. The reality is we think 2018 is what we call a headline election year. In other words, if we could predict what the news headlines will be for the next 2 weeks, that could very easily swing the House from Republican to Democrat or Democrat to Republican. It's just going to be that kind of fickle type of year in our opinion. Now, what's also true right now is we do believe the trend is starting to solidify in the direction of the Democrats. We've said all along the Democrats are probably going to have a 7 out of 10 chance of winning the House of Representatives. So what does that mean? It means if you had 10 days in a row you decide to vote, in 7 of those days, Democrats would take the House. But 3 days out of 10, the Republicans will retain the House, and I think you'd agree that's not statistically insignificant. And it really will be those headlines over the next 2 weeks that determine that direction. If we see headlines of children being taken away from their families by ICE agents or something like that, that's probably bad for the Republicans. I think we'd agree. But we also anticipate this Friday some good economic news of a surprising 3.4% annualized GDP growth. Well, obviously that's great for the GOP. So right now we think that is really what's driving the last 2 weeks of this election. A lot's been made about early voters and record numbers of people coming out and vote. In doing our statistical analysis of those early voters, ladies and gentlemen, they were the people who were always going to vote. They were the people that always vote every 2 years. They just decided to go early this year because they're pretty excited about 2018. Thus far, we are not seeing a huge wave of new folks that generally don't vote consistently. We're just not seeing that in the data of early voters. Now, what it does mean is we do think that Democrats will take the House. What does the next 2 years look like for President Trump? Well, I can tell you it's going to be a very long 2 years for President Trump. The Democrats believe the Republicans have given up their role as oversight of the executive branch, and the Democrats want to come in and bring that back with a fervor. We'll see a lot of subpoenas, we'll see a lot of hearings, we'll see a lot of testimonies, all of those things bogging down the Republican agenda for the next 2 years. The real question, though, is does that lead to impeachment? As you know, the impeachment process starts in the House of Representatives, and the House of Representatives can define impeachment proceedings pretty much however they choose. So if the Democrats get that in their head that they want to impeach the president, they'll probably find some reason to bring that process up. But that does not mean that the president would be removed from office. You see, the removal from office is where it shifts over to the Senate. And in the Senate, to remove the president from office, you have to have 67 votes. And I don't care how good a day the Democrats have on November 6th of this year, they will not end up with anything near 67 votes in the Senate. So it's very unlikely that our president would actually be removed from office. He may very well be impeached in the House, like Bill Clinton was, but not removed from office. And since I mentioned the Senate, let's kind of jump into that. We know Democrats only need to pick up a net 2 seats in the Senate in order to gain majority. In this class of 2018, there are 35 senators, 26 of them are Democrat and 9 Republican. So math would tell you advantage Democrat, right? But it's actually the opposite of that. It's actually advantage Republican. Democrats have to spread their reelection money literally over half the entire country. Whereas Republicans get to focus their reelection money, albeit less money this year, but focus their reelection money over the 9 states they're defending, and they can tactically overspend in states they think they have a pickup. Right now, we believe the Republicans have a good chance of picking up a net 1. If the headlines are good over the next 2 weeks, maybe net 2 seats in the Senate, expanding their majority in the United States Senate. Which, of course, that would be an advantage for them. One thing I do want to make you aware of, I mentioned earlier that this whole partisanship and gerrymandering issue, that contentious type of politics has been bubbling up in the Senate for the last, say, 12 years or so. Where that's showing up is in something we call the primary effect. Let me explain. If I'm a Democrat running in a state primary for my state Senate, or for my federal Senate, and there are several other primary candidates in there, I have to keep moving further and further to the left in order to win that primary. But once I win that primary, I'm way out here in the political continuum. So now I have to somehow figure out how to politically correct pivot back to more of a centrist position in order to win a statewide election, because there's no way I can win a statewide election way out here. And Republicans are doing the same thing on the right. We call that the primary effect, and that's been very much alive in 2018. And that's where we've seen some candidates kind of struggle with that pivot back to a centrist position. And the parties are going to have to figure that out sooner rather than later, because I think you would agree all the political energy right now is way out here, be it right or left, and that's challenging these Senate candidates to make that pivot to a statewide election. Interestingly, the races I'm most interested in watching this year are actually the gubernatorial elections. There are 36 mansions up for election this year. 26 of them are held by Republicans. So you can see it's the exact opposite math that we had in the United States Senate. But the reason I'm interested in watching the gubernatorial elections is that the class of 2018 and the class of 2020 governors that will oversee the next redrawing of those House district maps. We'll do that after the 2020 census, and those new maps will go into effect in 2022. Now, does anybody know how long those maps last for? 10 years. So it's the governors of 2018 and governors of 2020 that will be able to put their thumb on the scale of the body politic in our country for the next decade. So kind of keep your eye on those races as well. Now, let's kind of move on. This next slide, honestly, I only had this slide because if I don't, someone will inevitably ask during Q&A. Someone's going to say, well, Jeff, who are the Democrats going to run against Donald Trump in 2020? So I try to keep a list of folks that I think are seriously looking at it. And the first thing you'll notice is the list is very long, but it's also very wide. right? What I tell audiences is, the good news is, if you're a Democrat, you still have a chance to be the President of the United States. Just get your hat out there. Now, I do have one a little typo up there. Under the entertainment section, you see that letter O. Who am I referring to there? Oprah. Ladies and gentlemen, if someone can be simply known by the first letter of their first name ubiquitously across the country, if she chose to get in, she would immediately be one of the top contenders in this race. There's no doubt about it. Now, I'm not saying she'd win. I'm just saying she'd be a top contender. The real question on audience's mind today, 2 years out from the 2020 election, well, Jeff, what kind of Democrat is going to make it to the top of this list? You know, a lot's been made about the political crevasse inside the Republican Party between conservative Republicans and more moderate Republicans. Well, ladies and gentlemen, that crevasse is equally big, maybe even a little bigger inside the Democratic Party, between the more establishment, centrist Democrats and the more progressive Democrats. And you see a selection of all of those types up here on the screen. I think it's going to boil down to the governor races in Georgia and Florida. In Georgia and Florida, both states, we have a rather progressive Democrat and we have a rather conservative Republican running for governor. If the Democrats win one or both of those states in this November's election, you have to assume immediately that the more progressive portion of the Democratic candidates on this list will go to the top of the list starting that 2020 race. Now, again, that's the start of the race. It's going to be a 2-year process in selecting the Democratic nominee, so anything can happen between now and then. So let's kind of move on. All of these things, if you put this together, it really puts Donald Trump at a crossroads. If the Democrats take the House of Representatives, he's going to have to decide what direction he wants to take his presidency. He has two choices. He can continue down this all-base strategy, this all-in base type of strategy we've seen the president use for the last 2 years, or he could take this road. And this road would be a road more like a Bill Clinton in 1996, where he said, you know what, I lost the House. I've got to cooperate with these folks if I want to get anything done. And you know Donald Trump as well as I do, you know that there's nothing he likes more than to win, right? And to win, he's going to have to cooperate with Chuck and Nancy. And so that's why I'm thinking that that's the crossroads he's on. The real question is, what impact does that have to the issues on the day? So let's start by talking about trade and foreign relations. In order to do that, though, we need to start from the same place. And I think George W. Bush absolutely nailed it back in 2000 when he said the problem with imports is that more and more are coming from overseas. Think about that one for a minute. I know it's early, but think about that one. Yeah. Now, I'm not disparaging the president. God knows what I've said in the last 5 minutes. I just think it's a funny quote, so I keep it in there. So let's kind of move on. In order to understand trade and foreign relations issue, we need to understand what type of platform Donald Trump won on and continues to operate from. And it really is a platform of America first, peace through strength. It's a rejection of globalism, believing that globalism was a net negative for the American worker. Now, Donald Trump is myopically focused on one singular issue. And that one singular issue is growing the U.S. economy. He could care less about promulgating democracy around the rest of the world. That was a George W. Bush thing. He wants to focus on growing U.S. economy. That's it. But what that means is we also know Donald Trump is not a fan of multinational or regional trade deals. He pulled out of the Trans-Pacific Partnership. He threatened to pull out of NAFTA. Now we know we've renegotiated NAFTA. We'll see if that actually passes the various legislatures, but we know that he's not a fan of that. We know Donald Trump would rather move to what's called a bilateral trade agreement world, where he believes that the United States will get the best deal possible by negotiating with every single country one-on-one. The challenge with that is, one, it's very laborious, right? That we have 135, 140, 50 countries around the world, and negotiation of these trade deals take years to develop. You got to develop the relationships, and then you start the negotiation process. It takes years, and they're about this thick, and they're full of mind-numbing details. Now, does that sound like a fun evening for Donald Trump? No, I don't think so. That's just not his strong suit. We actually predicted that Donald Trump would grow weary and tired of the slow pace of trade discussions. We predicted in December of 2016 that he would move very quickly to something much more tangible, something he can control, and much more direct, i.e. tariffs. Now, we thought we'd be talking about tariffs in October of 2017 because we also predicted not only would tax reform get done, we said it had to get done in 2017. But we know that got kicked from September to December. That's why we didn't start talking about tariffs until January of this year. You see, you couldn't have a discussion of tax reform and tariffs at the same time because it would have messed all the numbers up. So that's why they had to be separated in that manner. So now we're talking about tariffs. We need to understand what authority our president has. Well, Congress, in its infinite wisdom, pretty much kicked that authority to the president of the United States under the guise of national security. Donald Trump has interpreted the words national security rather liberally, and that's how we end up on tariffs on washing machines and dryers and things like that. Now, certainly there are some national security issues around steel and aluminum. I'm not doubting that. But I'm saying he's interpreting this quite broadly. But bottom line is, for the average American, there's still a lot of confusion as to what a tariff is. Understand that tariff is nothing more than a simple tax. That's what a tariff is. If we put a 10% tariff on Chinese TVs being imported, if you went to Best Buy tomorrow to buy that TV, how much more is it going to cost? 10% more. It's just going to be passed right to the consumer. And Republicans even warned the president for the last couple of years that, Mr. President, this is a bad way to do trade negotiations around the world. It only has a net effect of making U.S. businesses less competitive, and it costs the U.S. consumer money. So the question is, how much money does it cost? Well, the average American family under this 10% Chinese tariff is paying about $270 more a year. Now, we in this room may be fortunate enough that $270 isn't that big of a deal one way or the other. But if you're the average American family, that $270 is a car payment. Unique to this audience, right? It's also your monthly health insurance premium. So it's not insignificant to the average American family. Now, we know President Trump has threatened to go from 10% to 25% tariffs on Chinese goods. Ladies and gentlemen, that could be as much as a 110 basis point hit to GDP. Now, I mentioned earlier that Friday we expect these good GDP numbers to come out somewhere around 3.4%. Well, if you took 110 basis points off that 3.4%, you're back down to low twos again overnight just because of tariffs. And again, I'm not questioning the wisdom of it. I'm just saying that's kind of what the impact could be. Now, does anyone here know Jay Powell, the Fed chairperson? Anybody know Jay? No? Okay, no hands. Well, let me just tell you, Jay is not known to be extremely gregarious as a personality, which is probably good for a Fed chairperson, right? But it's bad for quotes in my business. He gave us this riveting quote about trade and tariffs and so forth. He said, if we have widespread tariffs that remain in place for a long time, that's going to be bad for the U.S. economy. Can we agree that's about the most boring quote you've ever read in your life? I'm like, come on, Jay, help me out. Give me something a little better. So given the fact that he's not personality-wise capable of that, I moved to someone else who could give me a little insight, and that was Lindsey Graham. I don't know if you know Senator Lindsey Graham from South Carolina, but he's always good for a good quote. He said on tariffs, he said, any policy which drives up the cost of Corona, tequila, or margaritas is a big-time bad idea. Mucho sad is what he said. I love Lindsey Graham. He's always great for a quote. So I thought you'd enjoy that. So I mentioned we're at a crossroads. So my concern is if Donald Trump decides to go down that all-based direction, then I think he'll only focus on what he can control. Ladies and gentlemen, our president, with the three parts of our government policy, the only thing he really controls is tariffs. So if he decides to go down this all-based strategy, I would anticipate a doubling down on this issue around tariffs and trade wars and things like that. And I think that's going to be the modus operandi for some time in our country, and I think that's going to be a challenge for us economically. I would like to believe that President Trump could lead the country and say, okay, country, I know this is going to be painful for everybody, but we're serving a bigger good. And let me explain why I think that is. I think if he would approach it that way and come to the American people and ask for shared sacrifice, I think he stands a decent chance of bringing American consumers along with him. Now, the other crossroads was maybe he goes down a Bill Clinton 1996 kind of deal-making type of strategy. Again, like Bill Clinton after he lost the House in 1996. Well, in that case, I think he'd immediately move to infrastructure. Democrats have said all along they want to move to an infrastructure deal. Republicans say they want an infrastructure deal. Everybody agrees our infrastructure is horrible in the United States, which is great for your service business, but bad for my car and my pocketbook, right? The reality is the Society of Civil Engineers say the United States infrastructure ranks at a D+. Now, that may have been good enough to get me through high school, but it's probably not good enough for my infrastructure if I'm going across the Golden Gate Bridge. Would you agree? The real question is, how do we address that issue? This is a problem between the two parties. They have very different ideas. Now, granted, this information is a little dated because no one's talked about infrastructure for about a year and a half now. So I'm kind of updating you where the two parties are beginning the negotiation process. Republicans want to start with a $200 billion fund, if you will, and that fund will be basically a matching fund. They want states and municipalities to raise revenues locally to access those matching funds to build and restore those infrastructure projects. He also wants to focus on private-public partnerships, where that money would be available in a matching way to private employers, and private employers would make a return on their investment through tolls and use fees and user fees and the like. Republicans believe they can leverage that $200 billion into $1.5 trillion of infrastructure development around our country. That's a pretty good delta on that $200 billion. But Democrats, they take a little bit different approach. Democrats don't like this idea of the matching funds. They want the federal government to actually stroke a check. They want the federal government, our United States federal government, to stroke a $1 trillion check in order to restore our infrastructure in the United States. Now, to give you perspective, the last year, as far as tax receipts to the federal government, they're about $3.5 trillion. And the Democrats want to stroke a $1 trillion check on top of that. So you can see it's a challenge. Even the $200 billion the Republicans want to put in would go right to our debt. And we'll talk about debt and so forth here in a moment. But bottom line, that same Society of Civil Engineers have warned us. It said, even $2 trillion would get us just back to above average. So I'm interpreting that above average grade to be somewhere around a C plus or so, maybe a B minus. So you can see we have a lot of work to do in our country around infrastructure. But this is the opportunity for Donald Trump and the Democrats to then negotiate about how to put an infrastructure program together. If Donald Trump goes that direction at that crossroads, I think that's an interesting direction to go. Because you could easily see Donald Trump claiming this as a jobs program, right? He's promised good paying, middle class, blue collar jobs. Well, building a bridge is the best way to do it. Last time I checked, you can't build a bridge in China and ship it across the Pacific and install it in Iowa, right? You've got to build it locally, and it takes skilled labor. So you could see Donald Trump going that direction if he got in his mind that he wants to be a deal maker. I think that's yet to be seen. We're going to have to find out how this goes over the next couple of weeks. And then probably about 8 weeks after that, we'll get a good flavor of what direction the president wants to move. I did mention that you're more than welcome to get the full presentation if you're interested. That's the text number. If you do text to that number, be sure to include your email address and we'll get the deck out to you. You can also email directly to that email address and my associate will respond with the presentation as well. Now, in case you haven't had time to capture that information, the remainder of the slides have that same contact information in the bottom corner. Okay? So let's move on to something near and dear to your heart, the Tax Cuts and Jobs Act of 2017. Now, when I'm talking about the law, I know you're familiar with a lot of the details, so I'm not going to get into the weeds about it. I actually want to remind you of how the law got passed. It was passed under a process called reconciliation in the United States Senate that allowed the Republicans to pass it with a simple majority, as long as it met two criteria. It couldn't add more than $1.5 trillion in debt on top of the debt that we were always going to add, and at the end of the 10-year budget window, it had to be deficit neutral. Well, I'm not that smart. I just plotted the numbers on a simple graph, and you can see it came in well under $1.5 trillion. It came in at $1.456 trillion. Now, again, that's on top of the debt we were always going to add. So what that means, ladies and gentlemen, barring any surprise to our debt situation, we're going to have north of a $27 trillion debt by 2027. I think we can all agree that's a staggering amount of money. Now, you work with finances every single day. You know that old saying, show me your budget and I know what your priorities are, right? Because we spend money on what's important to us. So it occurred to me, if the Republicans are wanting to spend an extra $1.456 trillion, I wanted to know how they chose to spend it. I wanted to see what they thought was important. So I broke the law down by its various spending categories, and I call your attention to the upper right-hand box. That is the cost of the permanent rate reduction for C corporations from 35 to 21%. That one change, ladies and gentlemen, cost $1.388 trillion of the $1.456 trillion. Over 90% of the debt add is in that one single box. Now, why that's important to you and I is it means that everything else the Republicans want to do, all the pass-through changes, all the foreign taxation changes, all the individual tax code changes, all the estate tax code changes, all of those had to be basically revenue neutral. In other words, if they gave us $1, they had to find $1 in revenue somewhere else to offset it. It's important to understand where those trade-offs were made. Now, in addition to that, it had to be deficit neutral. And again, I plotted the numbers on a graph, and you can see it is deficit neutral in year 10. Now, in order, we got a clicker problem here, guys. There we go. So you can see it's deficit neutral in year 10. Now, in order to stay within these two criteria, the Republicans had to make a lot of trade-offs. The biggest trade-off they made was that all the changes for C corporations are permanent. All the changes for you and I as individuals, you and I as pass-through business owners, you and I as estate planning individuals, all those changes are temporary, basically expiring in 2025. But you know better than most that anytime you play with the tax code, by definition, there are winners and losers. So I came up with a handy-dandy table that we can move through those winners and losers pretty quickly. I'm going to start on the winner column under the individual code. At that point, if you or your clients or people you work with were subject to the alternative minimum tax in years past, there's a good chance you won't be subject to AMT moving forward. They increased the phase out and the exemption amount significantly. The AMT has height impacted as many as 5 million U.S. taxpayers, now will impact sizably less than 1 million. So that's a great win as far as simplification in the U.S. tax code. High net worth individuals, a lot of people you and people you work with are very excited about the fact that they doubled the estate tax exemption. For a couple, they can give almost $22.4 million away before they're subject to the estate tax. So thank goodness we all squeaked in barely under that number, right? Yeah, but the reality is I think that's really a misnomer. A lot of people say, well, I don't need to do my estate planning now because I'm not going to have $22.4 million. Ladies and gentlemen, I fundamentally, completely disagree with that position. We've been given an absolute gift from Congress, but it's a gift we have to proactively go out and take. What I mean by that is I call this estate tax code like a freshly cut rosebud in your garden. If you walked out of your garden today and you cut off that rosebud, what happens the moment you cut that rosebud off? It begins to die and wilt. And that same thing's happening with your opportunity to maximize your planning around wealth transfer planning. We've been given a gift that we can now, instead of playing a tax avoidance game with the estate tax code, we get to play a new game. And that new game is a multi-generational family legacy plan. We can take this wealth inside your estate and we can turn that into a multi-generational family legacy, and you tell us what that legacy should be. It's a fabulous time to be working with your financial advisor on wealth transfer planning. But it is something you have to proactively take advantage of. So get that done sooner rather than later. On the bottom there, we have non-service pass-through business owners. I imagine a lot of you work in that space. You're a winner because of that 20% business deduction. I, on the other hand, am a service pass-through business owner. I'm a net loser, or a loser in this deal, and let me explain why. I'm a loser because the Republicans lied to me, didn't they? They lied to me last year because they told me I was going to be treated like any other business owner. And I'm not, because I'm subject to those income limits. I can earn up to $315,000 a year and take that 20% business deduction. If I earn between $315,000 and $415,000, I get a reduced deduction. If I'm so fortunate as to earn $415,001, I lose the entire deduction. It just doesn't stop. It goes away completely. Well, I think you'd agree that's a pretty steep cliff. But one thing I'm very concerned about is the average pass-through business owner, and maybe some people you work with, don't understand where that calculation comes from. You see, I love my wife more than anything in life, more than my own self. But I own 100% of the shares of my pass-through entity. She owns not one share of my business. But in order to figure out whether I get a 20% business tax deduction on my business that I own 100% of, I have to include my wife's W-2 income in that calculation. Those income limits are a joint taxable number, not a business income number. That one little difference, as you can imagine, makes a huge difference, especially if you have a successful spouse. If they're a professional or a medical professional, whatever, you could easily blow through that $415,000 and get nothing, no matter how little your business makes. So just be aware of that. Democrats made a lot of hay last December in saying that median income earners will actually pay more taxes under this code than they did the old code. And they're absolutely right. But they're right because of a little bit of a technicality. You know that those income brackets grow by CPI each year. What a lot of folks haven't figured out is the Republicans changed which version of CPI we're using. We're moving away from traditional CPI to what's called chain CPI or CPI-U. Net, it's a slower calculator of growth over time, meaning from now on, those income brackets are going to grow more slowly, slower than wage growth. So as Americans earn more money, they'll move through more brackets more quickly, thus pay more taxes in the long run. That process, as you know, is called bracket creep and is one of the primary ways the Republicans were able to stay within those two criteria we started our discussion with. Another thing that you ought to be aware of is there are just some inherent losers inside the tax code, the way it was written. They generally tend to be high-income W-2 employees in high-tax states, especially if they have high personal real estate value. Now, does that look like anybody you know? Yeah, probably so. And that's going to be about 4 to 10% of the tax-paying population. A lot of Americans are excited about this tax code, thinking they're going to get a discount in their taxes, and that's not necessarily true for the most successful W-2 employees in our country. Moving over to the business side, a couple of things I thought would be relevant for you would be the fact that retail's a winner in this tax code. Retail's one of the very few industries that pays close to the full corporate rate. Well, that full corporate rate went from 35 to 21. That's a win for retail. The other thing I thought would be interesting to you, as you know, is that your industry got accepted into this ability to write off 100% of your inventory cost, your floor plan cost, just like if you bought a piece of machinery. Well, you know how valuable that is to your bottom line, but it's equally valuable to a business owner that is in a capital-intensive business. Ladies and gentlemen, that's a great thing. We've seen a 33% increase in CapEx year over year from last year. That's a great win inside this tax code. U.S.-based multinationals, I know that may not be completely relevant here, but I thought you'd find it interesting. U.S.-based multinationals will do well under this code because we're moving away from a worldwide hybrid tax system to what's called a territorial tax system. A territorial tax system is rather simple. It simply says that if you and I own this U.S.-based multinational company, let's say that 30% of our profit comes from outside the United States. Under the new tax code, that 30% of our profits earned outside the United States is now 100% U.S. tax-free. Now, the theory behind that is very simple. First of all our OECD countries, the countries we compare ourselves to, they were already moving to a territorial tax system, so we looked a little bit like an outlier with a worldwide hybrid system. But second of all, Republicans wanted to make sure they didn't provide any obstacles for these corporations to bring that money back to the United States. If it's tax-free, they're more likely to bring it back to the United States, invest in a new plant, buy new machinery, put on a new line, put on a new shift, and that means more Americans working. And that was the theory behind moving to a territorial tax system. On the loser column, we have technology and pharmaceutical. Technology and pharmaceutical are kings and queens of offshoring their intellectual property and patents to low tax jurisdiction countries. What that's allowed them to do, and I use this word literally, is launder profits out of the United States tax system into these lower tax jurisdiction countries. That's how we ended up with $2 trillion of corporate earnings sitting offshore. That's no longer allowed under the new code, so that's a bit of a headwind for technology and pharmaceutical. Mortgage, builder, real estate, and charities suffer from the same reality. The other big simplification effort inside the tax code was basically doubling the standard deduction. Remember the Republicans said that 95% of taxpayers will be able to fill out their taxes on a postcard? It may not be a postcard, but it definitely will be the 1040-EZ form. Literally, it's expected that 93%, 92% of the population will be able to fill their taxes out on a 1040-EZ. But why that's a challenge to builders, mortgage, and real estate is, correct me if I'm wrong, when you and I sat down and we did the math, whether we could afford that new house or not, we factored in the fact that we got to deduct that interest off our federal taxes, right? Ladies and gentlemen, that's only going to be true for 7 or 8% of the population moving forward. And the reality is the average American has not figured that out yet. They won't figure that out until they file their taxes next spring. And they'll be surprised about that. So I think that could challenge the builder's mortgage real estate business early next year. Same thing's true of charities. We've not seen a hit to charitable giving this year because the average American hasn't figured out that they're not going to be able to take a charitable deduction. Once they realize that next year, I think that could challenge charities, especially charities that rely on lots and lots and lots and lots and lots of small donors. If that's a charity that you sit on a board of, you may be a little bit cautious next year and watch your inflows closely as Americans figure out the tax code. Now, what we also know, there's some planning opportunities, and I know you're not financial planners, but I know you're tax interested, so I'm going to share with these pretty quickly. Charity planning, I want you to be aware of this because of so many more Americans now are going to be non-itemizers. My parents are a great example of it. They're in their early 80s. They've got an investable net worth of about $1.6 million, and they have $150,000 a year in pension and Social Security income. They are a fantastic example of a customer or a client who will no longer itemize under the new tax code. So when we talk about charitable giving with my parents, because they're over 70 and a half, the very first money we ought to be doing their charitable giving with is their IRA. Now that sounds a little bit different than what we may have advised people to do in the past, but Congress made permanent in 2015 the ability to move money directly from an IRA to a charity if you're over 70 and a half, up to $100,000 a year. More importantly, that transfer counts as your required minimum distribution. Why that's important for a non-itemizer is if it counts as my required minimum distribution, I didn't have to recognize the income from my IRA, which I didn't need anyway. And so it's in essence like I got a tax deduction for that donation. So again, over 70 and a half, non-itemizers, very first money I'd be doing your charitable giving with is IRA. Now, the other thing that's impacted every American is this $10,000 cap on the state and local tax deduction. That's also why there's a big movement towards non-itemizers moving forward. Let's say that you give $8,000 a year to your church and school, and that $10,000 cap is the only other deduction you have. So $10,000 plus $8,000 is $18,000. If you're a joint filer, you're not itemizing under the new code. So you don't get to write off that $8,000 charitable donation. Well, I suggest you do what we call donation bundling, meaning you take this year's $8,000, you wait until next year with that year's $8,000. Now you're donating $16,000, and plus your $10,000 state and local tax is $26,000, and that year you would itemize. That way you get to write off all $16,000 of your charitable donation. Now, you may say, well, Jeff, my church and my school, they depend on that $8,000 for their general account. They need that money every year. Well, that's where you take this donation bundling idea and put those monies into a donor-advised fund. It allows you to donate all $16,000 in 1 year, but you as the donor still control the distribution of that asset. So you can change who it goes to, you can change how much it goes, you can change the frequency of where it goes, so you still control the asset even though you've gifted it out of your estate. So just kind of an idea is there. The other thing I want to make you aware of is state tax liability. By nature of the way the Republicans did tax reform, it's likely your federal adjustable gross income and your federal taxable income is likely to go up. Now, you pay a lower tax rate, so net you pay less to the feds. But how many states did tax reform last year? 0. So to the state, it's going to look like we all got a raise, even though we made the same amount of money we made last year. So while you may pay less to the feds, you're probably going to pay more to your state. If you're one of those lucky 4 to 10% of taxpayers that are paying more to the feds, guess what? You get to pay more to both. Thank you very much for your contribution. So we appreciate that. Now, we also know the Republicans have introduced Tax Reform 2.0, making those temporary changes permanent. Anybody here excited about Tax Reform 2.0? Good, because it ain't going to happen. It's a show pony. Republicans brought this pretty little pony out to make sure we remember why we vote for them, which is to keep our taxes low. The reality is the way they wrote those bills, they are not deficit neutral, so you'd have to have 60 votes in the Senate. Even if the Republicans do pick up a net 1 or 2 in this election, that won't get them close to 60, and then so therefore you'd have to rely on Democrats to throw it over that 60. Well, that's probably not going to happen. I think we could all agree. So we're not going to spend any more time on 2.0. One thing I do want to make you aware of, I know a lot of you are CFOs for your organization, so you're familiar with your retirement plans. And there is a bill that's sitting in the House waiting for vote, and it'll likely come up in the lame duck, called the Retirement Enhancement and Savings Act, or RESA. And it can change some of the things you think about around your retirement plan. One, if you're a small employer, it allows you to gather together with other small employers and share the administrative costs of those retirement plans, so it's not as burdensome to you as a small employer. More importantly, that way more American workers will have access to the retirement plan. Sadly, believe it or not, still 40% of Americans don't have access to a 401k at their work. So hopefully that will lead into that number. A lot of folks you work with probably are over 70 and a half. We know Americans are living longer, they're working longer, and now under RESA, you would be able to continue to contribute to your IRA. You aren't capped at 70 and a half. This is where I think it's interesting for you as CFOs. Also inside the Retirement Enhancement and Savings Act is the ability to add lifetime income products to your 401ks. Now, we've been able to do that for some time, but none of us did it. None of us did it because of a couple of reasons. One, we were concerned from a fiduciary perspective. If we endorsed, quote unquote, endorsed this lifetime income product in the 401k, we thought we were on a fiduciary liability for 70, 80 years into the future. And that's really scary as an employer, as a fiduciary. Second of all, the other issue was, well, if that employee signed up for that lifetime income product, but then moves to another job, they couldn't take it with them very easily. It was very cumbersome as far as portability. Both of those things are cleaned up with RESA, so hopefully we as employers will feel more comfortable about putting these lifetime income products in 401ks to make sure people don't run out of income in retirement. And also as an employee, just know that you have more portability with those products should you go to another employer. So good wins for employees and employers around 401ks if RESA passes. Now, this is a bipartisan bill, and the reason it's bipartisan is because it's actually paid for, believe it or not. It's paid for through a restriction on stretch IRAs. Right now, we can stretch IRAs and maintain that very valuable tax deferral through multiple generations in an unlimited amount. It's a great way to transfer your wealth if you have those large qualified monies. What RESA would do is cap our ability to stretch IRA through the first $450,000. Anything above $450,000 would go back to the old 5-year rules of 5-year distribution on those assets. I mentioned I was out in San Francisco, and I was talking to a gentleman, and he has over $18 million in his 401k. Obviously, a lot of tech stuff, and he did well with it, clearly. Well, think about what that means for his planning. If he can only stretch $450,000, that means they've got to liquidate $17,550,000 over 5 years. $17 million, I'm sorry. So you can imagine that's a big hit for their family. So just be aware that that's kind of the funding mechanism for the bill. Now, that funding mechanism could change before the bill passed, but that's the way it's written now. It does have the votes to pass. So these are some of the discussions and thoughts you may be having moving into plan year 2019 and beyond. Okay? So let's kind of move on. Let's talk about U.S. fiscal policy. And I love this quote from Charles Schultz. It's not the Peanuts cartoon variety Charles Schultz. Something much more exciting. It's the Council of Economic Affairs Charles Schultz. And he said about fiscal policy, he said, it's not so much a question of a wolf at the door, but more like termites in the woodwork. I love that quote. If there was a wolf sitting outside that door and that wolf was trying to get in, we know it was there, right? It'd be barking, it'd be howling, it'd be scratching at the door. It'd be showing its teeth. We'd be petrified. But that's not the fiscal policy issue we have in our country. It's more like termites in the woodwork. We don't see them, we don't hear them, but we know they're in there 24 hours a day, eating away at the structural stability of our economy. I thought that was a fabulous quote. Now, I do a lot of panels around the industry, not unlike I'm sure you're having some today. I'm often paneled with an economist for obvious reasons. I'm always shocked how many economists say, Jeff, you're really making a mountain out of a molehill with this whole publicly held debt to GDP ratio issue. Over the next 10 years, it's just going from here to here. Don't worry about it. I said, well, how can you ignore the last 250 years of American history, where the only time we had a higher debt to GDP ratio was World War II? And last time I checked, we've not mobilized the entire free world after fascism, but we're spending like we are. Now, you'll get a kick out of this being a financially savvy audience. This is a 700% increase in publicly held debt to GDP ratio, not dollars. A 700% increase in our debt to GDP ratio since 1980. And that doesn't include our Social Security because we're still working, or our benefits when we retire. If you add those on, you see what trajectory we're on. Now, don't get me wrong. There are perfectly appropriate reasons why our federal government should run deficits, even sizable deficits. For example, like in the 80s, we were trying to overspend on military spending to bankrupt the USSR. Or after 9/11, we had a tax cut and we had to go to Gulf War II. Or like 2008, we were trying to spend our way from going into the Second Depression. And we can argue those were good deficit spends. What I'm questioning, looking at the projection portion of that graph, what I'm questioning is the wisdom of running such big deficits in what we can argue is a pretty darn good global economy. As a matter of fact, we're on pace for fiscal year 2019, which we're roughly a month into already, that this year's deficit will again reach $1 trillion. And we haven't seen that since 2008. In a good economy. And again, I'm just questioning the wisdom of that. You know, Janet Yellen, another Fed chairperson, she said, you know, this is the type of thing that should keep people awake at night. Now, I don't know if you know Janet Yellen or not, but if it keeps her awake at night, it gives me nightmares. She's just that kind of person. It really boils down to how we spend our money, because we only spend our money in three ways: mandatory, discretionary, and net interest on their debt. Now, this is as a percentage of GDP, the relationship of that spend versus GDP. What you'll notice is that since 1968, the line that's coming down is the discretionary spending. So what's in discretionary spending? Oh, things like national parks, federal courthouses, every single federal agency you can think of, like Department of Education, Department of Energy, the IRS, and all those others, the VA, and 100% of the defense of our country. All that's been coming down as a percentage of our GDP. What's going up is mandatory spending. That's Medicare, Medicaid, and Social Security. Those programs are growing at 7.2% a year. That 7.2% growth rate is directly comparable to long-term GDP growth. Does anybody know what GDP's average over the last 10 years? 2. But our fixed expenses are growing at 7.2. You see the problem, right? I actually think the most interesting line on here is the net interest on our debt. As you know, between 2008 and 2015, we doubled our federal debt. We're on pace to 50% again, our federal debt over the next 10 years. And that line's relatively flat. Why is that line relatively flat? Interest rates have been zero. We've doubled our debt. We're on pace to 50% again, our debt, and we haven't had to pay a dime for it. That's the chicken that's going to come home to roost. Now, I know what you're saying. You're a very smart audience. You're going to say, but Jeff, the millennial generation is so much bigger, the baby boom generation. We just need to die our way out of the problem, and we'll be fine. Don't worry about it. I say because I'm a Gen Xer, right? Well, that's not actually correct from an actuarial perspective. If you look at the center section, normally I would point to it, but it's a little hard to here. That center section, that medium color, you see that slight increase in slope at the beginning for about 12 years? That's your millennial generation. But if you look out into 2040 and 2045, there's only one growing portion of our population. What age group is it? 65 plus. See, we have an actuarial problem in our country. So we are not going to die our way out of this problem. That's just not realistic. Now, you probably think that I'm a scaremonger or I'm just throwing all these horrible things up there, but I'm not alone in this story. Even the public press has been very vocal about this. Wall Street Journal, the U.S. government bonds are paying more than debt from other developed countries for the first time in 2 decades. Signpost. How many of you were aware that when our federal government went to auction to sell our debt in January of this year, the buyers sat on their hands? They didn't buy until we increased the yield by 25 basis points. Then we got some buyers. Signpost. I think we're going to look back on this date in 4 or 5 years and we're going to say, wow, look at all those signs that we just ignored. The reality is at this point you realize that AICPA did not bring me in as a motivational speaker. Would you agree? Yeah. But I am an optimist, and let me explain why. I think it's perfectly captured in this quote from Winston Churchill from the 1940s, from World War II. He said, you know, you can always count on Americans to do the exact right thing, but only after they've tried everything else. And that's where we are right now. We're still trying other things. The thing I love about this quote, I don't know if you're familiar with Winston Churchill greatly, but he had a beautiful way of speaking. He spoke in a very formal type of English way, as you might imagine. Well, this is a pretty plain English quote, isn't it? It's kind of boring. And the reason why was he was not speaking to the English population. He was speaking to the American worker. He was saying, American worker, I know you're not in the war yet, but I know you'll do the right thing when the time comes. And so I think that's a little history on that quote. I think it's fascinating. So while I am an optimist, I'm also a realist, and there are only 2 levers our federal government has to pull. That's tax policy and spending policy. Democrats, you need to realize that 61% of our federal budget is mandatory spending, growing at 7.2% a year. We can have a fabulous debate on how to cut mandatory spending, but we should not be debating that we need mandatory spending cuts. We absolutely do. But Republicans, you need to realize you can't run our country, given the changing demographics and the increase in longevity, at 16.5% revenue to GDP. How many of you agree in a good economy like we're enjoying today that the federal government should be able to balance their books? Is that an unrealistic expectation? Well, if you want the federal government to balance their books, that 16.5% revenue would have to go north of 21%. Over a 25% increase in total federal tax revenue. Where do you think it's going to come from, folks? I'll get to that in a minute. You know, the reality is, we talked about a lot of things today. We talked about state taxes, how your state taxes are likely to go up. We've talked about how you may need to be a little more tactical in the way you do your charitable giving to make sure you get the advantage of that charitable deduction. But as an investor and as a business leader, I'm here to tell you, I put forward that your financial advisor, your tax advisor, has never been more important to you than they are right now. You see, we've always relied on our financial advisors' help to get the right asset allocation. But I'm suggesting that moving forward, value is created by having the right asset location. Asset location is based on my unique tax situation. Let me give you an example. I'm a 52-year-old guy. Let's say I make $500,000 a year. You have another 52-year-old male making the same $500,000 a year. The only difference between these two people, I own my own business, he's a W-2 employee. Now, we both have 13 years until retirement, so we should have roughly the same asset allocation, those pretty little pie charts, because allocation is about time frame. But if our advisors have us in the same asset location, they've committed malpractice. They committed malpractice because my tax realities were always a little different than a W-2 employee, but under this new tax code, they're a lot more different. And that should be reflected in my asset location. See, value can't be created in the idea of asset volatility management. That's been commoditized. How our financial advisors can bring value to you and I is through understanding tax volatility in the future. Let me explain. This red line shows the highest marginal tax rate going back to 1913, all the way through 2015, or 16. What you notice here is there's a little volatility in that red line, right? I put forward to you that in December of 2017, an unbelievably new precedent was set. The precedent is this. First of all, is a confluence of two events. And the first one is tribal politics. How many of you think tribal politics are here with us for a while? You think it's going away? Okay, probably not. So tribal politics, and then it got combined with the Republicans using reconciliation to rewrite the tax code. Let me put a posture out here, or postulate. Is it possible, not probable, is it possible that we could end up with a Democratic president in the near future? I think it's possible. Is it possible that a Democratic president could enjoy a Democratic House and a Democratic Senate? Yeah, I can see that happening. Ladies and gentlemen, at that moment, the Democrats will have every vote they need to completely rewrite the tax code once again. That could be as early as 2021. And here's the catch to it. Republicans, when they rewrote the tax code, they had to stay within those two criteria, right? Couldn't add more than $1.5 trillion, had to be deficit neutral. Why? Because they were decreasing revenues to the federal government. Do the Democrats want to decrease or increase revenues? They want to increase revenues. They'll have every vote they need to change the tax code, and they will be completely unconstrained in how they choose to do it. I think you need to be aware of that. I think the reality is tax volatility, the frequency of changes is going to go up, and the amplitude of those changes are going to get bigger. There's a faction of the Democratic Party that are seriously talking about tax reform and what that looks like for them when they have the opportunity to do that. The more progressive portion of the Democratic Party honestly believe the highest marginal rate can go to 63% before we have any negative economic impact. So I'm telling you, tax volatility is what we have to help our clients manage moving forward. And the only way to do that is to have a multitude of income generation opportunities so your client gets to pick and choose how they expose themselves to the tax code. So with that, I've talked at you, I'm guessing, for about 55 minutes. Guessing. I wrote the presentation last night, so I'm a little unsure. So with that, let's see what you have on your mind, what questions you have. I'm not sure if we have any coming on electronically, but we also have the 3 mics here, so please feel free to jump up and give us a question that way as well.
So let's start with, and please join in here. We got several, but if you'd like to join, please do. What effect, if any, will the Kavanaugh confirmation have on the midterm elections, and which group does it help, or neither?
Yeah. Generally, what it did was it staved the decline of the Republican vote. And Republican enthusiasm. It stabilized that and actually increased it in certain areas of the country. I really don't think it has I don't think it fundamentally changes the numbers one way or the other, because for every Republican that's now energized to go, there's a more progressive liberal that's happy to go and as a protest vote against the Kavanaugh nomination. So I think it kind of washes out, but the real effect was it stopped that decline of Republican enthusiasm, because that was really heading south. Yeah.
Got it. Okay, let's see. Thoughts on job prospects for blue-collar workers, thinking long-term, manufacturing, robotics, automation, et cetera. You know, this audience is keenly interested in automation with autonomous vehicles and so forth, and you think about the number of drivers in this country is tremendous. So would love your thoughts on some of those topics.
You know, I like history very much. And if you go back in history and you look at every time we made a economic transition from agrarian to industrial to information to knowledge, every time we make that transition, we lose about 10% of U.S. workforce. 10% of the U.S. workforce can't emotionally make that transition. They just fall through the cracks. What I'm concerned about is those transitions in our economy are happening at a much faster clip. You're familiar with Moore's law, that, you know, of course, the increasing frequency of those changes. So my concern is you can only lose 10% so often before it becomes a real problem. And I think we're at the precipice of that. I think the automation in drivers is going to be a huge one, because you're absolutely right. You think about every semi-truck you see on the road, every cab, every Uber, everything else. It's a big change. So that's one big area. Now, I can make two arguments where the president is on that same crossroads scenario. If he decides to go double down on the tariff scenario, that will drive some production back to the United States, because it makes us relatively competitive to those higher taxed imports. So we're already seeing some of that. There's some talk about bringing some of the Apple iPhone production back to onshore to the United States. As you know, the majority of that's in China. In addition to, and then on this side of the crossroads, if we go down the direction of making a deal, that's likely going to be around infrastructure, and those are going to be great blue-collar jobs right there. That infrastructure is vital to our country for obvious reasons, but it's also a great jobs program. Yeah.
Gotcha. Okay, we got any? Okay. Hey, I'll keep rolling. So, onshoring, a lot of talk about bringing the money, you know, the $2 trillion back onshore and so forth. You know, some of the things that have been seen is that hasn't happened nearly as much as it was expected. Your thoughts on why, when, if ever, you know, what does it really do for the economy when the money comes back onshore and those sorts of things?
The majority of money that is moving back onshore, sadly, a good chunk of that's going into stock buybacks, which is good for us as investors, but not necessarily good for a big positive for our economy. It's not being invested in new machinery. It's not being invested in new product lines and the like. But we've only seen about $300 to $400 billion of the $2 trillion working its way back to the United States. So hopefully we'll see that trend reverse. I think that, in combination with getting some clarity around these foreign tax rules, yes, believe it or not, the IRS was caught a little bit surprised by how quickly tax reform got done, and so they're still giving us clarifying what the tax law means to them, right? So the foreign taxation is one area that we really don't have a lot of clarity on for U.S.-based multinational companies. So I think as they get that clarity, that's when we can start seeing some more regular transfers in those monies. Yeah.
Got it. So, okay, tariffs. There was some chatting going on online about, you know, explaining that a little deeper about practically and technically, how does it work?
Yeah.
So, you know, who does it get remitted to and collected, and to whom, all those sorts of things?
Well, it's actually quite simple. It really is just let's say it's a 10% tariff. It's just a 10% tariff on whatever group of product is coming into the United States. And it's not much more complicated than that. It's collected. That money goes to the United States Treasury, goes in there. So what we have seen this year, one reason, two good things are happening, if you want to look at it in kind of a contrarian way, is one, the GDP's gone up. And some believe one reason the GDP has gone up is because domestic manufacturing has gone up. People have been loading up on inventories in preparation for bigger tariffs down the road. But the tariff process is really quite simple. It's just collected at the import location and brought in. Yeah, when those are claimed based on the bill of lading. Interestingly, that's where this blockchain technology will really come in. And I'm not an expert in this. I'm not a tech guy. I asked the tech guys this morning. I'm not a tech guy. But bottom line, this blockchain technology will make that process much more efficient. And therefore, that tax collection will be much more clear. Because right now, there's still a lot of transshipments going on. In other words, everybody said, well, why did we hit everybody with a steel tariff instead of just China if they're the ones dumping cheap steel? Well, if we didn't tax everyone, what they would do is they'd take the steel from China, they'd ship it to Taiwan or to Vietnam, and Vietnam would put their stamp on it, said made in Vietnam, and then it would come to the United States tariff-free. So that's called transshipment, and that is a big problem with tax collection, tariff collection, and so forth. So that's why he generically did the steel and aluminum tariff. What I'm interested in, I do believe Canada will get a reprieve on aluminum, maybe both aluminum and steel, which that should help the automotive industry here in the United States.
Speaking of automotive, I know this group would love your thoughts on, what Washington sees as far as disruption with respect to electric vehicles and, autonomous vehicle regulation and those sorts of things. Anything in your thoughts there?
I think you're giving Washington elected officials way too much credit on thinking ahead like that. I think they know about these things. There are some techie kind of elected officials, and they're kind of into it. But the average, all you had to do was look at that Kavanaugh hearing and go, my God, how old are these people, right? And I don't mean to be an ageist. I'm not being an ageist, but I'm saying they're not the people I'm excited about writing the future of our tech regulations, right? So we have a disconnect there. One effect in Washington, D.C., as we put more fiscal constraints on our elected officials, they've really decreased the size of their staffs. So what used to happen is the staffs would write the bills. K Street would weigh in, the lobbyists would weigh in, but that's the bill that went to the floor. For all intents and purposes now, ladies and gentlemen, K Street is writing the bills because all the staffers that got fired out of the Capitol building simply moved to K Street. So now K Street's writing the bills. They present them to the elected officials, and relatively unchanged, they go to the floor. Yeah.
I won't read this one exactly as it was written. So if you listen to your financial planners who told you you'll have a lower tax rate when you retire, and with the comments you've made, now you're going to withdraw your qualified money later, you're not in good shape.
That's true. Yeah. So that's where I'm saying that because of this audience, I didn't get into kind of a real heavy financial discussion around planning. But the reality is the only way to deal with that tax volatility is to have a diversified source of income generation. And so you have to proactively create that diversified source of income generation as you accumulate those assets. For example, as a business owner, if my effective tax rate is going to go way down under this new tax code, I should pay as much taxes as I possibly can right now. I'm happy to fully fund my Roth instead of my traditional 401k. I'm happy to convert my traditional 401k to a Roth. So you have to just think differently based on that unique tax situation. So what you want to be working with, if you serve in some of that capacity within your organizations, if someone's effective tax rate's going down, pay taxes and build up their taxable income bucket. I know that's counterintuitive because we never thought that way before, but I'm here to tell you, you need to have, when you retire, you want 3 equal buckets of money. A bucket of taxable, a bucket of tax-free, and a bucket of tax-deferred. That way you get to decide how you expose yourself to a volatile tax rate environment. Because I think that volatility is going to go up and down, and you want a portfolio that you can pick and choose how you expose yourself. One of the biggest concerns I have for the average American saving for retirement is 100% of your retirement savings is in one place. Where is it? 401k IRA. One tax strategy when they retire. So whatever that red line is for them, that will determine their lifestyle. So they're setting themselves up for a very volatile life cycle or lifestyle in retirement. And I don't know about you, but I don't want the IRS in charge of my lifestyle. So that means you have to have a diversified source of income generation, which means you may pay more taxes today in order to achieve that.
Let's talk interest rates. Your thoughts on moderation of interest rates with the economy. This person wrote, the economy's already showing signs of slowing down. Floor plan interest for these people is crucial. So your thoughts on rates?
Yeah. No, I would anticipate interest rates continuing to go up. The reality is we've had some turbulence in the markets right now. There is some concern. Maybe we're getting to the tail end of this economic cycle. First of all, let me say I'm not an economist, okay? So I'm giving you my political perspective as to what's happening. The Fed has been desperate in order to increase their interest rates because at zero interest rates, they're a eunuch. They can't do anything. They're useless, right? And what they're frustrated with is Congress won't do fiscal reforms. If we could get fiscal reforms done, i.e. tax reform and mandatory spending reform, then that gives us a little bit relief on the financial side and gives the Fed a little more authority around interest rates. But right now, I think you need to anticipate interest rates continuing to go up a bit. Now, that could take a pause if we see a protracted issues here in the market. But at the fundamental level, we still have a solid economy. And so I think Donald Trump kind of confuses the market with the economy, and those two things, as you know, are not the same thing. But certainly long term, you have to assume that interest rates are going to continue to push up a little bit. Yes, sir.
Could you comment, if you have something to say, about the Fed's unwinding?
Yeah.
And also at the same time, they're raising interest rates.
Yeah.
It would seem intuitive to me that they should first unwind and see what happens.
Yeah.
And then deal with the interest rates later on.
So the point is, I'm not sure if you're familiar, but through that 2008 fiscal crisis, the Fed actually not only went to zero interest rates, but they also bought assets. So they ended up with about $4.5 trillion of assets on their balance sheet when normally it's pretty much zero. So now they're trying to figure out how to dump that $4.5 trillion back into the United States economy without it being a huge inflationary pressure up. The reason I understand the logic of that you would unwind first before you raise interest rates, but understand again, they're eunuch. They can't do anything at zero interest rates. They wanted to have some muscle, so that's why they started raising interest rates too early and unwinding at the same time. The reality is that $4.5 trillion, they want to be able to unwind that very tactically, not strategically. So in order to do it tactically, they need more strategic help over here on interest rates. So they're going to unload as they see appropriate and as they can without causing additional inflationary pressure. The worst thing the Fed can do is overshoot, and we end up in an inflationary environment, right? And so that's what they're very concerned about in unloading that $4.5 trillion. Did that answer your question? Okay, thank you.
All right, we got about 2 or 3 minutes. Let's go real fast. Quick answers. Will Biden run for president?
Yeah.
I thought it was quick.
My gut says he's going to make a run at it. If he does not, not a short answer. If he does not get Obama's endorsement, which I'm not sure he will, by the way, if he doesn't get Obama's endorsement, that could keep him out. Will
Trump run for re-election?
Right now, I'd say yes.
Okay. All right, we got 1 more minute. Let's dig into one other one. Bonus depreciation. Okay, 100% bonus depreciation was not put into effect for 15-year leasehold improvements. And it was our understanding that technical correction is not available. Therefore, Reform 2.0 was kind of the hope for that. Your thoughts real quick on that topic.
Well, there are a lot of things inside the code that we need technical corrections on. The problem is there's not the votes to get it done right now. The Democrats don't want to take any vote that makes it look like they're helping the Republicans. So we think that Tax Reform 2.0 is kind of getting in the way of getting that technical corrections bill, a pure, just technical corrections bill. The Democrats know that we need technical corrections. So my gut is I think it will carry. But the question is what time frame? Hopefully, obviously, lame duck would be the time when you would think they could get that done, because we're going to have a lot of Congress people that lost their job, and so they're willing to vote along with the party to make things, or along with the greater good. Let me put it that way. So lame duck is when we would hope there'd be a technical corrections bill passed, but 2.0 is kind of blocking it right now because the Republicans are showing us that show pony. So, hopefully we'll get it sooner rather than later.
All right, one last question. We've got 1 minute to go. Is it as poisonous in D.C. as it shows in the media, online, et cetera?
Yes, it is. It definitely is different than it used to be. And quite honestly, I blame the 24-hour ideological news for that, because they feed those narratives. A lot of people say, well, Jeff, why aren't you on Fox News? Why aren't you on MSNBC or things like that? They don't want me because I point fingers at everybody. And that's not what they want. They want you and they want you, so you guys fight. That's what drives clicks. That's why it drives things. Just understand this. Fox News, MSNBC, CNN, all of them, they exist for one reason and one reason only. Sell ads. That's all they do. So understand what their motives are is to keep your eyeballs on their screen, and that's it. And they're going to tantalize you and tease you and tickle you into it every single time. So quite honestly, I spend very little time on the video media, cable media and things like that, because all I hear are the talking points, and I can predict what the talking points are. I don't need them to tell me. I think that's what's driven it. So it's a lot more out in the open. It is also much more visceral than it used to be. Every negotiation in D.C. right now is a zero-sum game. If you win, I lose. If I win, you lose. And that's not the way it's supposed to work. It's supposed to say, hey, look, I could care less about your park, but I'll vote for your park if you vote for my bridge. And that's not what we're getting now, unfortunately.
All right. Hey, we're going to thank him in just a minute, but before I lose you, we're going to take just a 5-minute changeover break. That's it. So we're getting started in about 5 minutes, but before that, Jeff, you've been great. And Michael, thank you for introducing and hosting him. And let's give him a big round of thanks. Okay.
Thank you very much. Thank you.